the second thing is again, going back to the last segment, that's the index crediting potential. You need to have the best of both worlds. You need to have good index crediting potential followed by moderately low, low to moderately low income rider fee, so that you don't have a lot of drag on there. So those are the two things that we would evaluate if you came to us and said, Jeremiah, this is definitely an income play. My primary objective is guaranteed lifetime income, but I really would love the opportunity to have my account value last longer, in a perfect scenario, last until I die. So I have a death benefit. The things you're going to want to look at, again, good index crediting potential, low income rider fee. Pretty simple.
Yeah, and I think it also adds another element there of having that lower fee. You've got the potential, in most of these, you have the potential to take out up to 10% withdrawal if needed. Not that we need that liquidity, or not that that's intended for it, but again, having the options and being able to be dynamic in those retirement years is essential. So having that lower fee will really help with that.
Yeah. And again, if you don't have a secondary objective of caring for that account value, and if it lasts longer or not, maybe you don't have a legacy benefit, or you should have liquidity elsewhere besides the annuity. Otherwise, it wouldn't be suitable. But if that doesn't matter to you, then neither should the income rider fee, in a sense, because it doesn't matter if it's deducting out of that account value and depleting it quicker than normal, or quicker than some other options. Then it doesn't matter. But that's really where it comes down when comparing apples to apples and finding the most optimal solutions according to what you deem to be important from a value perspective. That's where it's key. Do you value the carrier rating over the cost of the rider fee, or do you value higher income and not care so much about the carrier rating? So that's where we really take you through this engaging and interactive process to help you determine that, and then help point you and guide you in the right direction of which annuity options you should be considering. And then we'll go through, identify maybe a top 3 scenario according to your needs, and then start to break it down from there and look at these nuances one by one to help you make a well-rounded and thorough, educated decision.
Yeah. Yeah. No, that's great. And really just hitting on the last subject here to round out our list. That's going to be the enhanced income benefit, which you had briefly talked about when we were looking at the index performance. So a big one that we consider here, and if this is important to someone or not, that enhanced income benefit for long-term care feature that can double, either at least multiply, whether that's 1.5 or 2 times. It can double your income for up to 5 years if you're unable to perform 2 out of 6 activities of daily living. So we're looking, not everybody may have this on their list, but it's a consideration in making that decision.
The way I look at that, because some people have a long-term care. I hope that most people have a long-term care plan outside of this annuity. But to be honest with you, long-term care is one of the biggest crises in retirement planning, because most people haven't planned for it. And by the time they have started, at least with this baby boomer generation, it's too late, because they can't qualify for the more affordable long-term care coverage, the traditional coverage through the life insurance part of the business. And so what happens is that they start to look at other options, and knowing that you can find these benefits in an annuity is pretty great. But that's where you have to make sure you're not getting into a trap, right? You're not getting into a product that says they offer it, but the likelihood of it being available when you get to the end of the road there is very small. So that's where, like I said before, there are a few carriers that have either a contractual guarantee that they'll offer that enhancement on the income benefit for long-term care, regardless of what happens to the account value and if it depletes to zero. And then there are other companies that may not have a contractual guarantee, but they do have stronger index crediting potential to, provide a better opportunity for long-term account value sustainment, so that enhanced income benefit is available and there when you need it most.
Yeah. Yeah, I think that's a great example. And really, we've seen some examples in which that fee is, 2%, or can go up to 2%. So, how's that really going to help somebody if we really are relying on having a feature like this and having that enhancement?
Yeah, exactly. Can you see my screen, Zach? I'm sharing our friends again at American Equity here on the Income Shield.
Yeah, I can see
So
it.
they have a few different rider options in this particular product, and if you go with option 4, that's where it unlocks their what they call their well-being rider. Sounds great. Love it. Really cool name. And you'll notice that in this case, on a joint life basis, it's getting a 1.5x multiplier.
Mhm.
If you had a need for long-term care and you qualify being unable to perform 2 out of 6 activities of daily living, the $743 in monthly income would increase to just over $1,100 a month, and pay that $1,100 a month for up to 5 years to help cover those increased costs from long-term care. And the rider fee goes up on this one 10 basis points to 1.2%. But I really want to show you an example of really, what could potentially happen if maybe you had a need long term for that long-term care, maybe later on in your life. And if you don't have good index crediting potential, or maybe you have too much drag from the income rider fee, what can happen? Now, can you see this, Zach? What is it showing on your screen?
No, I still see your screen with the income.
Okay, let me share it. Let me try it again here
Yeah.
real quick. I had to change windows. That's what happened. Where is it? Here it is. Guaranteed. Here we go. All right. What about now?
Yes, sir.
All right. So what we're doing now is we're breaking out into an illustration. And in this illustration, I'm not going to cover the guaranteed values. That's pretty simple. It's just assuming there's never any interest earned from the index crediting strategy. And it's just showing you the example that your income is guaranteed for the rest of your life, even if the account value here on the left in the green column depletes to zero. But the point of this exercise is to show you that this is a product that may or may not have the enhanced income benefit rider when you get to the end of your road and you have a need for long-term care. And so here what we're looking at is your contract value or account value, which is what we've been referring to it as in this episode.